Hello, I hope you're doing well. My name is Jaclyn Veno from Goloso Learning Solutions, and welcome to the Genuine Learning blog, your resource for timely and relevant updates from all the standard setters. So have you been wondering how the One Big Beautiful Bill Act is going to impact your financial reporting for income taxes? Well, you have come to the right place. GLS stays up to date on everything that comes out of the AICPA, including non-authoritative, but still very, very helpful items like technical questions and answers. Think of these as a very helpful Q&A. Now, during this blog, what we're going to do is we're going to break this down and we're going to see how this can be used as a resource for us and maybe even answer some of these questions that you've been having. With that being said, let's go ahead and get started. Now, the formal name of this technical questions and answers is FASB ASC 740, Implications of the One Big Beautiful Bill Act, also known as OB3, which is what I'm going to refer to it as we go through this blog. And this was issued by the AICPA in January of 2026, so just a couple of weeks ago here. So why did the AICPA decide to do this? Really just to be helpful and answer some of our questions. As I mentioned earlier, technical Q&As give us non-authoritative guidance. So they aren't issuing any new standards or anything like that. What the AICPA is trying to achieve with this is just to answer some questions as to how OB3 is going to be impacting different organizations. So as you may know, OB3 was signed into law in January of 2025, and it made some pretty significant changes to the US federal tax laws. So naturally, a lot of practitioners have questions. The two biggest questions include the topics that you see covered right here, and that includes questions on ASC Topic 740, which is income taxes and the reporting for those, and also the new and enhanced tax disclosures that came from ASU 2023-09, and we are going to walk through both of these things separately here. So the first question was really on interim reporting. People really just weren't sure exactly when to recognize the effects of OB3 in their financial statements. Weren't really sure how to actually do that. So the AICPA has answered that question for us by telling us that the effects of this new legislation are not going to be recognized before enactment, and they will be recognized in the interim period that includes the enactment date. So in this case, July 4th of 2025 was that enactment date. So during the enactment period, entities must distinguish between discrete items and also the estimated annual effective tax rate items, or again, a little bit of a mouthful here, lots of different acronyms, the EAETR. So OB3's tax effects might produce both. In this circumstance, we might have some discrete items that are impacted, and in some cases, we might have the EAETR impacts as well, depending on your company's specific facts and circumstances, including optional or elective provisions. So what are some examples of these discrete items that might be impacted? We have the remeasurements of deferred tax assets and deferred tax liabilities for changes in tax laws or rates. These would be allocated to income tax expense or benefit from continuing operations. But that's not all. We also have the effect on prior year current taxes. These are basically changes in income taxes payable or refundable from a prior year due to new tax laws or tax rates. And then last but certainly not least, we have change in valuation allowance on beginning of year balances. In this case, the effect of a change in judgment about the realizability of an existing deferred tax asset in future years. However, though, what about these EAETR examples? Now, companies must evaluate OB3's provisions, including, once again, those elective provisions, to determine which effects are discrete, which we already discussed, versus what is going to be considered EAETR. So examples of those would be what you see right here. And that would be the tax effect of a change in tax laws or rates on taxes currently payable or refundable for the current year, and the tax effect of a valuation allowance on current year originations. So that all had to do with Topic 740. Now, what about this ASU that recently became effective for public companies? We have ASU 2023-09. And just to give you a little bit of history on this ASU, this came out really to achieve one goal, and that goal was to provide investors and stakeholders with more transparency and some additional information about concentration risk. Public companies naturally are going to have more reporting requirements here than the private companies, but in a nutshell, this requires specific categories in the income tax rate reconciliation. We have a numerical reconciliation that is required for public business entities, and then we have a qualitative, so in words description, for the non-public companies. And people were asking the question, so, okay, we have these new requirements from this ASU, but how does OB3 impact us with this ASU? Basically, where would this go when we're talking about this new and expanded reconciliation that I now need to provide? Well, the federal effects of OB3 must go into the effective changes in tax laws or rates enacted in the current period category. So when we're taking a look at OB3, that is exactly where this is going to go. And this category reflects any cumulative tax effects of the change in enacted tax laws or rates on the current and deferred tax assets and liabilities at the date of enactment. So that is exactly where that one's going to go. And what about for the state and local tax effects? So that is going to be presented in the state and local income tax net of federal income tax effect. And this includes individual state legislation that incorporates OB3 provisions into state law. Now, we also need to be careful and exercise a little bit of caution here when we're determining where to reflect the components of valuation allowance changes that come from OB3 related changes. So considering that with how that relates to these reconciliation categories, well, what we're going to need to do here is provide explanations to investors and stakeholders in our financial statements. We need to include different things, like what is the nature and effect of this reconciling item? What are the underlying causes of this item? What judgments were used when we were trying to categorize this piece of information here? So hopefully that will make things a bit more clear for investors and stakeholders going forward as well. So that is pretty much all that we have for today. I do want to do a quick shout out for our upcoming audit staff level training cohorts. We have our 2026 schedule finalized, which is something that we're very excited about at Golosso Learning Solutions. So if you are somebody and you work at a firm and you're maybe a manager or a partner and you're looking for some training for your staff, I would highly recommend these cohorts here. They are very highly rated and they have a near perfect Net Promoter Score, which is something that we're very proud of. And that is all we have for today's blog. If staying up to date with, things that come from the AICPA is part of your role, explore how GLS can help you stay ahead of the curve. Also, if you're in need of other additional CPE, we also have included a QR code for you here as well. We have lots of courses on accounting topics, auditing. We also have government and nonprofit A&A as well, if you're in need of your Yellow Book requirements, as well as professional development and audit staff level training. In addition to our live courses, we also have webinars, and we also have an LC Vista platform as well. Once again, my name is Jaclyn Veno from Golosso Learning Solutions, and thank you so much for tuning in today. Hope you have a wonderful rest of your day.